Everybody, Happy New Year 2024. Again, it's Bob Thompson here with Martin, and we're just going to be talking about markets and a little bit extra stuff today. We're going to talk about some of the other services that we provide, which are really important, I think, for clients also. So let's dive into it, Martin. I think it's been an exciting couple of years, and I think no different in 2024 here.
Yeah, definitely. Thanks for having me again. I'm really happy to be here and just update our clients. Yeah, 2023 was no exception. We definitely had some volatility to start the year, especially after that large correction that we saw in 2022. We did see markets rebound, and a big reason for that was falling inflation and central bank support. What we've seen lately is every time something's gone wrong, central banks have stepped in. And of course, we saw that in 2008, then again during the pandemic. But last year, you saw a bunch of regional banks fail in the US, and the US came to rescue right away, providing liquidity to markets, and markets chugged higher. So that really sets the theme for the discussion for where we are today.
Sure.
I'll let you touch on that, Bob.
Yeah, as far as clients are concerned, we've always been clear in the past that we manage portfolios for the client's unique circumstances, right? So markets are going to go up and markets are going to go down. We don't have control over that. But to touch on what you said, we can control how we react or respond. Actually, reacting is not a good thing to do. You want to respond. And there's a big difference between responding and reacting. And I think experience helps you through those times. So yeah, I mean, 2022, I talked about that last year and said that that was a tough year for bonds, for stocks, for pretty much everything that paid income, etc. And there was a lot of negativity going into 2023, and of course, things worked out okay in 2023. Now, 2024. People don't think there's going to be recession. Everybody's pretty happy. So, we're defensively and consciously, managing portfolios to find good opportunities. I think, that something that surprised people for a long time is just what you said. Central banks kind of come in and print money or do what they do to straighten things out whenever there's even a touch of concern in the market. So, if that continues, we just have to see what the market is expecting to happen, what is kind of factored into the market, and then realize that the opportunity probably lays somewhere else when that's the case.
Exactly. They say that history tends not to repeat itself, but it does rhyme, and we're
Right.
going to touch on
Hmm.
that in terms of what we see for the upcoming year. But we want to dig into kind of now that the fight of inflation seems to be dead. Everyone's celebrating, and everyone's expecting a lot of interest rate cuts going forward, and that's why markets are getting excited because they believe interest rates will cut down. What are your thoughts on that?
Yeah, I think the expression "skate to where the puck is going to be, not to where it's been" is so important. And 30 years in this business, I've just seen it happen so many times. People kind of think that the same thing is going to start to happen. So, if one group of stocks is done really well, then everybody starts to chase and panic and chase that group. And we're kind of in that environment right now. If people, it's funny, if we've had a lot of inflation, then you look at expectations, inflation expectations, everybody thinks there's going to be a lot of inflation going forward. Well, it didn't work that way. Right now that inflation is very, very low or looks like it's under control, everybody thinks there's not going to be any inflation anymore. Right. And that's exactly the point in which it starts to turn up again. And that's what happened in the 70s. And we're not saying that it's going to be a 70s type of environment. I mean, a lot of people don't even remember what happened in the 70s, but we had some severe inflation due to an oil crisis that happened, and then we had that inflation dwindle away and then come back with a vengeance. We can talk about that, but I just think that the portfolio or your thoughts should be like turning a big ship. You don't turn on a dime, nothing's going to change tomorrow, but kind of have a good outlook as to how things are going to be for the next few years. Look 18 months out, 2 years out, and invest accordingly, because that's how you actually add value, and just stay calm in the markets.
So yeah, you touched on how inflation, came in waves and how that's happened before. in the 1970s. So you mentioned that, so let's dive into that. I'm going to bring up a chart here, and it shows U.S. inflation during the 1970s in the blue line, and we overlay what has recently happened here in 2019 to where we are today, and it looks awfully similar. And we said history doesn't tend to repeat itself, but it does rhyme. And we don't expect it to look exactly the same. Nothing will actually ever happen the same, but there are a lot of similarities in terms of what happened in the 70s and today. So, do you want to dive in deeper in this?
Sure, I was born in 1969, so I don't remember it exactly, but I've studied my history very, very well. And some clients might remember back in the late 60s, there was lots of technological innovations, and companies like Polaroid, Kodak were the companies that led the market and did extremely well. And kind of in a similar situation right now, and this is going to change the world with the technology that's happening. Well, that kind of was the peak in the market. And then we also had a couple other things happening, right? The late 60s was a huge, huge cultural revolution, Woodstock, and all these things that hippies, etc., in the late 60s. But we also had the Vietnam War, right? So in the United States, they had a policy, Nixon had a policy called guns and butter. We can do both. And what that means is we can support the Vietnam War, the costs that are there, and we can feed our people and make everybody happy so we can all buy refrigerators and live a fantastic lifestyle. We can do both. Well, that was fine, but they created a lot of money. They printed a lot of money. Does that sound familiar to today? And then that caused inflation in the early 70s when oil prices started to rise. Well, what happened is the central bank, raised interest rates. They figured they killed inflation. So if clients just kind of think back to what was happening in the 70s. There was a bad recession in 1973, 74, and then they started to lower interest rates because of the recession. Well, what happened is it caused inflation to start up again. So the late 70s were marked by extreme inflation, peaking in kind of 1980, and interest rates went to 21%. A lot of people lost their homes. Mortgage rates went up dramatically. Gold went from $200, $100 an ounce to $800 an ounce in the late 70s, which is what happens in inflationary environments. And then there was extreme pain at the end of the 70s into the early 80s, which set us up for the next investment boom. So nothing is the same, but I think that's the worry right now. And people were worried there was going to be inflation. Like I said, now nobody's worried about inflation because they think it's gone away. I think there could be an uptick in inflation again, and we're looking at that in the portfolios and saying, how can we protect our clients' capital, give them a good income, and protect against this inflationary environment, which might happen. It might not happen, but the fact is, the markets right now, nobody's factoring in any inflation, and usually, when nobody's factoring something in, you're good to kind of take the other side of the bet a bit.
And you're already starting to see key commodities like oil and copper turn higher, while other sticky components like housing, which is very close and dear to our hearts here in
Yeah.
Canada, remain an issue, especially with the immigration policies that we have here in Canada today. Really continuing to see price inflation on the housing front. So I'm not so sure it's going to go away, and it's more tied to how we think central banks and governments will respond to any economic weakness that may happen in the year ahead. Either way, it's a possibility, and we want to be positioned for it.
Yeah.
So let's just move forward right now to how the economy is performing. Just touch on it. So what we have here is a chart of U.S. manufacturing and during an election year, because it has been slowing over the last year. We saw slowing growth, and now we actually have seen negative manufacturing growth in the U.S. And Canada is very tied to it, to our neighbors down south. So that's why we always bring it up. But in this chart, we highlight January 2016 because it was a very similar time where policymakers, had to be a little bit more lenient in letting things run and letting inflation pick up so that the economy was in a bad place when the election came at the end of the year. So I think this is very topical, and markets usually do well in election year, but the areas that might perform well might be tied to inflation or prices picking up. You want to touch on that?
Yeah, I think one thing to cover is that's important on a practical level for clients is the stock market is not related to the economy
Yeah.
in the short run. In other words, if when you read in the newspaper that we're in a recession, generally speaking, the market's already bottomed or already on its way there and starts to work its way back up from there. And that's where people kind of panic and say, "Oh, we're in a recession, better sell everything." Well, market already figured that out a long time ago. And when we're in a recession, central banks start to print money and provide liquidity and do all these things for the market, which tends to help the market. So I just want to say, with a caveat, things are slowing down and maybe showing that there's a recession, but that means that a lot of things are already depressed in price, and there's a lot of opportunity there when that happens. So yeah, I mean, usually when you raise interest rates this fast, what happens is it stops demand, economy starts to slow, we start to go into recession, and when everybody thinks the market's going to go down, it goes up, and when everybody thinks the market's going to go up, it goes down. That's generally what happens. That's what happened in the last year or two. People are all pretty positive right now in the U.S., so that's a time for us to say, well, maybe there's other places to be. There are things that are not necessary, where people aren't necessarily as positive, and that would be commodities, like you said, which tend to do well at this time. People have kind of forgotten about that area, right? It's emerging markets, right? Emerging markets are hugely undervalued compared to the U.S. right now, and some of the most undervalued that they are in 20 years. So what we're looking at is, the road less traveled. That's the commodity area. That's the high dividend payers, which were kind of beaten up a bit in 2022, 23. But it's also around the world sort of investments, right? There's so many places in the world where they're not even thinking of things being at all-time highs, right? Things are at lows. And, I've said it many times before, but when you go shopping and you buy a can of tuna at the store, you buy the tuna when it's on sale by 50%, right? You don't go in this week and say, "Oh, wow, price of tuna is $2 this week and it was only $1 last week. Perfect. Let's load up." I mean, it's crazy. You go in and buy it when it's cheap. So you look for things that are cheap, that are out of favor, and that's definitely outside the US. It's definitely Canada. There's a lot of things that are cheap, and it's definitely in areas that have not risen substantially in the past year or two.
Completely agree. And I think that's a great segue to transfer over to the next portion of it, because we've covered markets, we know where we're headed moving forward, we've been relatively disciplined. We're going to continue to take advantage of the high income that we've created in the portfolio, and we want to even enhance that. If they are going to lower rates, we want to make sure that we're have good exposures to those high dividend payers now, because they can even go up in price and enjoy a good dividend along the way. But again, let's change gears right now and let's discuss total wealth solutions. And this is a big part of our practice. Definitely is a good portion of the value that we provide for clients, well beyond investment management. So I'll just bring up this slide here. I'll let you talk about
While
it.
you're doing that, while you're doing that, Martin, I just wanted to comment. Clients have either received calls from us or they see these structured notes in their accounts, and I just want to kind of talk about why we're doing that. With some of these structured notes by the banks pay 10, 11%. When you buy it, it's a contract between you and the bank that the bank says they'll pay you this much interest through this note. If these things happen, it gives you the downside protection on the market, which really we found helps clients to not worry about the day to day when they know there's that downside protection there. And also they're going to get a good stable income. And the reason we've started, using them even more so in client accounts is because this contractual relationship, but also because of the high yield that it's paying. And if you can get this yield without taking, the day-to-day risk of the market, I think it makes sense. And it kind of adds into this total wealth solutions, which is, looking at where the clients are now, where they have to be down the road, and making sure they're on the right track to get there in the easiest way you can do it, and the less stress, less anxiety sort of approach.
Yeah, and that's part of our advanced planning process, which you've always broken down for all of our clients. And it's made up of four key components, and you've touched on the first one, which is wealth enhancement, and that makes up investment management, financial planning, and even insurance within that bucket. And then there's other important initiatives such as wealth transfer, which we could touch on, which is, it could be estate and trust services and tax solutions.
And that's a good thing to bring up because, yeah, I mean, Raymond James manages a lot of money for clients around the world. And reason why that's important is because there's depth in this. I talked about earlier, we can't control the markets, right? We can control how we respond.
Yeah.
But what's important is we can control how we respond within the big picture of, where the client's going. And there's trust services here, Raymond James, which I think is important. People have trust accounts. People have executor needs, wills needs, consulting in that area, which is all available here. And I encourage people to kind of take advantage of that through our team because that's what we're here for. I'm not an expert in wills and trusts, but that's where we have experts on the team. We have expert financial planners, which kind of know where you are now and can have an outlook as to what the world's going to look like for you in 10 to 15 years, because that's really important. I mean, if I say to a client, what happened to the market on, September 18th, 1995, I don't know, maybe that was a super important day at the time, but nobody cares about it now, right? All people care about is did I achieve my objectives over time, right? And I think that's important. So these sort of things tend to help you focus on what's important to you. Investment management, that's what, I get up in the morning for. That's important to me and same with Martin. But, it's not necessarily the most important thing. Charitable giving, right, is very important for people, right? A lot of people, if you have charitable intent, especially in your will, you can structure that in a way that it's going to be tax effective for you too and save you a lot of money on tax and also give and help the community. So as you see, estate services, tax solutions, insurance, investment management, financial planning, charitable giving. These are all things that are important, but also help to enhance your returns. And I think that's what's really important because, I often say to people, if you're buying a GIC that pays you 5%, you're not getting 5%, you're getting 2.5%. The CRA is getting 2.5% also. So you're in partnership with the CRA. I don't know if you knew you were, but you're giving half your money back to them, right? So it's important to kind of increase your after-tax returns. And that's, especially with higher interest rates now, that's all part of what this advanced planning is all about. So I encourage people really to lean upon us and use that. We've got spectacular, professionals and teams here at Raymond James that can do that.
It's definitely one of the biggest reasons I came over, and I know why you brought the practice over
Yeah.
7 years ago to Raymond James is because of the strength of these people that we've worked closely with to help a lot of our clients in unique situations to achieve those bigger life goals beyond just performance.
Right. Yeah.
So, with that being said, I think that's a good way to end the video. And I wanted to thank everyone for watching today. And if you have any questions, and of course, if you want to touch on any of the total wealth solutions, please reach out to us and we'll set up a meeting right away to address any of the complex needs that you need solutions for.
Yeah, and I'll just say that, you always see Martin and I on here, but Tanya is an integral part of the team, and Tanya is responsible for all this integration with the financial planning, with the trust services, and everything else that's important. She's responsible for all that, so an integral part of the team. And one day we'll get her on here. One day. All right. Well, with that, we'll talk to everybody later, and thanks again.
Thanks a lot, Bob.
Okay. Bye.